Should be fine now. Let's resume. Let's begin. So we'll continue with our discussion on gifts. So we've discussed about section 56 to 10. We've discussed the first two parts. We learned that number 1, 56 to 10 is applicable to all assessees. And then we learned that under 56 to 10, you have various categories of gifts, 5 categories in all. Number 1, we have the cash gifts. Then number 2, movable gifts for no consideration. Number 3, movable gifts for inadequate consideration, and then immovable gifts for no consideration and immovable gifts for inadequate consideration. Under immovable gifts for inadequate consideration, we've discussed the 6 steps. Step 1, STV. Step 2, actual consideration. Step 3, difference. Step 4, standard 50,000. Step 5, 10 into 10% of actual consideration. And step 6 is nothing but step 4 or step 5, whichever is higher. So if the step 3 number, that is if the difference is more than the higher of these two, then you will say that the step 3 is taxable. But if the difference is lesser than the higher of these two, then nothing will be taxable. Okay, so this was our second part of the gifts discussion. Listen to me now. The third part under our gifts discussion. See, we have some exempt gifts. You must have, I'm very sure you must be recalling, we did learn, right, that gifts from relatives are exempt. We've come across various such adjustments in PGBP head. Several times we've spoken about exempt gifts, right? So we'll discuss about each of those exempt gifts one by one now. Listen to me. What are the exempt gifts? Number 1. If you get a gift from a relative, the first gift, if your assessee gets any gift from a relative, then the gift is going to be fully exempt. See, it doesn't matter what kind of a gift, whether it's a cash gift, movable, immovable, no consideration, inadequate consideration, doesn't matter. As long as a gift is received from a relative, any gift from a relative is going to be fully exempt from tax. Okay, so first of all, gift from relatives are fully exempt. But here comes a bigger question, that what do you mean by a relative? Who is a relative? See, in so many places we've come across the word relative, we've come across the word family, and if you noticed, everywhere we've had a different definition, we've had a different discussion altogether. Remember, within salaries itself, in 2 to 3 places we came across relatives, and everywhere we had a different discussion. Under education perquisite, we had spoken about salaries. Then under interest on interest free loan, interest or concessional interest loan, even there we had spoken about relatives. So in 2 to 3 places we've already spoken about relatives under salaries head. But for the purpose of this discussion, what do you mean by relative? Here we are saying that gifts from relatives are exempt. But what do you mean by relative? See, when it comes to the definition of relative, hereafter, especially when you come to chapter 6A and all, you will find a different definition of relative in each section. So please draw your diagrams for each of the relative discussions so that it's easier for you to recall the diagram. See, it's much difficult for us to recall a paragraph, but if I ask you to recall a picture, it'll be much easier for you, right? So this point onwards, we will keep coming across in many places different definitions of relatives. So wherever you come across the definition of relatives, draw your diagram. How I'll show you, the diagram will help you recall later. Like for gifts, okay, your diagram is going to be like this. Now what does this mean? If I am the assessee, relatives will include my brother, my sister, my children, grandchildren, great-grandchildren, and so on, my parents, grandparents, great-grandparents, and so on, and also brothers and sisters of my parents. It will also include my spouse, will also include my spouse's brothers and sisters, will also include my spouse's parents, grandparents, great-grandparents, and so on. But my spouse's parents, brothers and sisters, I am not covering. I will also cover my spouse's children, grandchildren, great-grandchildren, and so on, which indicates that yes, I'm also going to cover stepchildren. Alright, so relative will include assessee's brothers and sisters, assessee's children, grandchildren, great-grandchildren, and so on. This is called as lineal descendants. Then we also have lineal ascendants, that is parents, grandparents, great-grandparents, and so on. We'll also include the assessee's parents, brothers and sisters, spouse's brothers and sisters, spouse's parents, grandparents, great-grandparents, and spouse's children, grandchildren, great-grandchildren. So if I receive a gift from a relative, irrespective of what kind of a gift it is, irrespective of what the value of the gift it is, the gift is going to be fully exempt. So any gift I get from a relative, the gift is going to be fully exempt. Are we crystal clear with our first exception? Yes, so what are we learning about? We're learning about the exempt gifts, right? So we have learned about 2 points already. Our third discussion here is about the exempt gifts. So the first exempt gift is any gift that you get from a relative is going to be fully exempt. Who is relative? You've understood. One more thing, guys. Relative will also include spouse of all these people. So it will not only include my brother and sister, it will also include their spouses. So spouses of all these people are also covered. Alright, so this was our discussion regarding relative. If you've understood this, answer my question. See, two transactions I'm talking about. Transaction number 1, I am giving a gift to my uncle. Another transaction, my uncle is giving a gift to me. When I say uncle, I'm talking about my mother's brother, let us say. I want you to tell me, are both the gifts exempt? What do you think? I gave a gift to my uncle and then my uncle gave a gift to me. And here when I say uncle, I'm talking about my mother's brother. Are both the gifts exempt? Are both relatives? See, listen. Listen carefully. First of all, who is the assessee? The giver or the recipient? In IFOS, who is the assessee? The recipient. Always, the recipient of the gift is going to be the assessee. My uncle is receiving a gift from me. So if my uncle is the assessee, tell me, for the uncle, who am I? If my uncle is the assessee, who am I for my uncle? His sister's daughter? Sisters, brothers and sisters are considered as relatives. Is sister's daughter considered as relative? No. So for my uncle, I am not a relative. For my uncle, this gift is going to be taxable. For my uncle, I am not a relative. But if I get a gift from my uncle, I am the assessee. Who is my uncle now? Will the uncle fit into this diagram? My uncle would be my mother's brother. Relative, guys. Here my uncle will be considered as a relative and therefore the gift is going to be exempt. This is a very, very important observation. I am hoping you've understood it and you've grasped it. For the assessee, his nephew and niece are not considered as relatives. So if the assessee gets a gift from his nephew or from his niece, it will not be from a relative and hence it will be taxable. But if the assessee gets a gift from his uncle or from his aunt, from his parents, brothers and sisters, those gifts will be considered as exempt because assessee's uncles and aunts are considered as relatives. Did you understand? So while my uncle is my relative, I am not my uncle's relative. Does this make sense to you? Yes. So you got to make sure, you first of all have to identify who your assessee is. For your assessee, the giver has to be a relative. See, I'll re-explain it to you. The assessee is my uncle, let us say, and he's getting a gift from me. So for my uncle, who am I? I am his sister's daughter. So I am his niece. Nephew and niece not considered as relative. Brother, sister considered as relative, but their children not considered as relatives. So for my uncle, it's going to be a taxable gift. For my uncle, it's as if he did not get a gift from his relative. But if I get a gift from my uncle, if I am the assessee, my uncle will be my parents' brother, right? My uncle would be my mother's brother. So parents, brothers and sisters are considered as relative and hence exempt. Crystal clear with our first exception. Now listen to the second exemption. In the second exemption, my assessee is a bride or he's a groom. In other words, my assessee is getting married. So on the occasion of marriage, some person gives a gift to the assessee. Some person gives a gift to the assessee on the occasion of marriage. This gift is going to be fully exempt. It doesn't matter who this person is. Relative, not a relative, doesn't matter. Doesn't matter what the value of the gift is. any gift received on the occasion of marriage is going to be exempt. Okay, now listen to my practical situations relating to this. What if the bride or the groom are getting married, but what if the bride's father is receiving a gift? What if the bride's father is receiving a gift from a person on the occasion of his daughter's marriage? Will this gift be exempt? No, this gift is going to be taxable. Are you understanding? This gift is going to be taxable. Why? Because who should be getting the gift? The bride and the groom, they should be getting the gift. The assessee should be getting married. That assessee should be getting the gift on the occasion of his marriage. That gift will be exempt. If on the occasion of the bride or groom's marriage, if the parents are receiving the gift, then that's going to be taxable because the gift should be received by the bride or the groom. Like, for example, if the gift is in the form of a check, the check should be in the name of the bride or the groom. The check should not be in the name of the bride's father. Understanding? This was my first situation. Listen to my second situation. Let us say there was this assessee. He got married some 10 years back, let us say. It's been 10 years since he got married. And this assessee had a very close friend. This friend was settled in the US. This friend had not visited India for the last 10 years at all. Now, after all these years, the friend is visiting India. And when the friend meets the assessee, the friend gives a gift to the assessee saying, I was not able to attend your marriage. I was not able to give you the gift. So here's the gift now. After 10 years, is this gift going to be on the occasion of marriage? Can you exempt this gift? Yes. Yes, this gift is going to be exempt because nowhere it's mentioned that the gift has to be given on the date of marriage. In simple words, what matters is that the gift should be relating to marriage and relating to the assessee's marriage. Understanding, the assessee should be getting a gift relating to his or her own marriage. If assessee's parents are getting a gift, okay, then that's not going to be exempt. It's going to be exempt only if the bride and groom themselves are getting the gift, but not necessary on the date of marriage. All right, it should be related to marriage. All right. Yes, definitely it should be within reasonable time. But what I'm telling you over here is from an actual case. And in that case, the court held that reasonable time is a fact which varies from case to case. And in this case, we can say that the gift is connected to marriage because we can substantiate the reason being the friend had not even visited India all these years. So it can be substantiated. So if it is possible to substantiate, then yes, you can call it as a gift on the occasion of marriage and hence exempt. It doesn't matter whether it is your first marriage or second marriage, that is irrelevant. On the occasion of your marriage, you should be getting a gift. Any gift on the occasion of marriage is going to be fully exempt. Doesn't matter what gift, doesn't matter from whom. The first and the second exceptions are the most important exemptions. The first exemption was the first exemption was from a relative. Who is relative? Brother, sister, parents, grandparents, great grandparents, children, grandchildren, great grandchildren, and brothers and sisters of my parents. My spouse's brothers and sisters, my spouse's parents, grandparents, great grandparents, and my spouse's children, grandchildren, great grandchildren. Then we discussed that the second exemption was if my assessee gets a gift on the occasion of his marriage, the gift is going to be fully exempt. Then after that, coming to the third exemption, the third exemption is something that I think you are kind of already aware about. You know about this already. You know that if a person dies and if you get any will, you get any gift under a will or an inheritance, any gift you get under a will or because of inheritance, this gift is going to be fully exempt. It doesn't matter whose will. Not necessary it has to be your relative's will. Not necessary you must have inherited from your relative. So anything that you receive under anybody's will or inheritance, that's going to be fully exempt. So that's your third exception. Anything received under will or inheritance is going to be fully exempt. Okay, then coming to the next discussion, the fourth exemption. The fourth exemption is interesting. Listen, let us say there was this person, Mr. Green. He was on his deathbed, which means he thought that he's about to die. So because he is about to die, he did not want too many disputes after his death regarding his assets. So what he did was, whatever assets he had, he distributed those assets as gifts to his, let us say to his friends and family, thinking I'm anyways going to die. So, in other words, the assessee, in contemplation of his death, see, he did not wait for his death, he did not wait for the will to settle his assets. Instead, before his death itself, in contemplation of his death, thinking he's about to die and wanting to avoid subsequent disputes, he distributed his assets to all his friends and family. If the assessee receives any gift from a person who is on his deathbed, this gift is going to be fully exempt. So, what are your exemptions? What was your first exemption? Your first exemption is any gift that you receive from a relative is fully exempt. Remember the uncle niece relationship. Second exemption was any gift you receive on the occasion of marriage. All right, these gifts are also going to be fully exempt. Here we discussed that the bride and the groom, they themselves should be receiving the gift and not their parents. And then we discussed that what matters is that the gift should have a connection with marriage. It is not necessary that the gift has to be given on the same date as marriage. Then coming to the third situation, under a will or inheritance, if you receive any gift under a will or inheritance, that gift is going to be fully exempt. Doesn't matter whose will, doesn't matter whose inheritance. Then we learned if a person is on his deathbed, which means he's contemplating his death. In that case, even before his death, if he wishes to settle his assets, and if the assessee receives any gift from such a person, this gift is going to be fully exempt. But now, what if this person doesn't die later? He thought he's going to die and therefore he distributed his assets as gift. But what if he doesn't die later? If he doesn't die later, he should take the gift back. If he doesn't take the gift back, then it will be taxable for the assessee. Okay, so if in contemplation of his death, if a gift was given, then the gift is going to be exempt. But if he doesn't die later, then he must ask for the gift back. If he doesn't ask for the gift back, then it's going to be taxable for the assessee. All right, this was your fourth exception. Then coming to the fifth exception, if the assessee receives anything, any gift, if the assessee receives from the local authority, the gift is going to be fully exempt. Like from the local authority, or let us say from the central government or from the state government, all of this is generally fully exempt. Also, if the assessee receives any gift from any approved charitable institution, if the assessee receives any gift from an approved charitable institution from the central government, state government, from the local authority, all of this is going to be fully exempt. Then listen to the next exception, the sixth exception. The last 3-4 exceptions are not very important, but because a part of our syllabus, listen very carefully. Let's finish this. Do not compromise over here. See, let us say there was a company A Limited and I was a shareholder of A Limited. This A Limited decided to merge with B Limited. Okay, so now what will happen to my shares of A Limited? See, A Limited is going to merge with B Limited. A Limited is not going to exist anymore. So therefore, A Limited will come to an end. So also its shares will come to an end. I will automatically get shares of B Limited, guys. Do you remember we've learnt about a similar situation or exactly the same situation even in capital gains? Do you recall? Yes. Now, under capital gains, do you remember we learned that it is sort of an exchange, but there is going to be no capital gains? There's going to be no capital gains over here. Later, whenever he sells the shares of B Limited, whatever was the cost of acquiring the shares in A Limited, that's going to become his cost of acquisition. That is what we've learned. Right, guys? That's what we've discussed in capital gains. But listen, the assessing officer tried to play a little smart here. Assessing officer said, okay, fine, I can't ask you to pay capital gains. Let's treat it like you got it as a gift from B Limited. Shares, movable asset, capital asset, you're getting movable asset for no consideration, come on, pay tax. The assessing officer started, deliberating on the fact that they can tax this under gifts, under IFOS. So that is why it was clarified that any shares you get upon merger or any shares you get upon demerger, upon merger or upon demerger, if you get any shares, this will not be considered as taxable gift. This will be an exempt gift. We don't want the assessee to pay any tax at this stage. Okay? Are we clear with this? So this was your sixth exception, that any shares that you get upon merger and demerger are going to be fully exempt. And then lastly, guys, if the holding company gives any gift to Indian wholly owned subsidiary, or if wholly owned subsidiary gives any gift to Indian holding company, these gifts will also be always fully exempt. Alright, so these are all your exempt gifts. Alright, totally 7 exemptions we've learned. The first 2 are the most important. The first one is any gift that you get from a relative is going to be fully exempt. Secondly, if you get any gift on the occasion of your own marriage, that gift is going to be fully exempt. Thirdly, any gift you get under any person's will or inheritance, again fully exempt. Fourth, any gift that you get upon contemplation of a person's death, fully exempt. Then we discussed any gift that you get from the local authority or approved charitable institution and all, fully exempt. Then we learned any shares that you receive upon merger, demerger, exempt. And lastly, the holding company, wholly owned subsidiary relationship, any transactions between these entities will also be fully exempt. Alright, so this was our entire discussion regarding the exempt gifts. Okay, now listen, we do have a few more small points left under gift. Let us discuss them and then we'll start the questions. Listen to the fourth part of our discussion under gifts. See, if a resident is giving a gift to the non-resident, for the non-resident, this gift will be taxable if the source is in India or if it is received in India. Do you agree? See, who's the assessee here? Tell me. See, I'll help you understand this. Who is the assessee? Resident or the non-resident? Who is receiving the gift? The non-resident. So the non-resident is the assessee here, right? I told you in IFOS that the recipient is the assessee. So the non-resident is receiving the gift. The non-resident becomes the assessee very clearly. So this non-resident, for him, is this gift going to be taxable or not? That's our whole question. For the non-resident, an income is taxable only if the gift accrues in India or if the income is received in India. See, the question now is that where is this gift accruing? Where's the source of this gift? The law says that if a resident is giving you a gift, I do not have to check anything else. If a resident is giving a gift to the non-resident, we can say that the gift is accruing in India. Where is it received? We don't know. But if a resident gives a gift to the non-resident, we can say it is accruing in India and therefore we can say it is taxable for the non-resident. It becomes an Indian income. You remember, right? For non-resident, only Indian incomes are taxed. Indian incomes means incomes which are accruing in India, incomes which are received in India. Only those incomes are taxed for the non-resident, incomes which accrue in India, incomes which are received in India. Alright, so the question now is, if a resident is giving a gift to a non-resident, where is the source of the gift? The source of the gift is going to be in India. Why? Because the resident is giving the gift. So there's a condition. If the resident is giving a gift to a non-resident, the source of that gift is in India. That gift is deemed to accrue or arise in India. The gift is deemed to have a source in India. Alright guys, so this was our discussion regarding the resident to non-resident transaction. We'll assume that it is accruing in India and therefore it will become an Indian income and therefore it will be taxable for the non-resident. Okay, so these were our 4 parts in our gift discussion. First was that it's applicable, its gift concept is this section is applicable to all assessees. Second discussion was the different kinds of gift. Third discussion was about exempt gifts. Then finally we discussed about resident to non-resident deemed to accrue or arise in India. Okay, now listen, I'm taking you forward to just one last point under our IFOS discussion. A very specific situation, a very peculiar situation I'm talking about. Listen, here what happens is, there's a closely held company. This closely held company has issued shares to a person. What I'm discussing with you is section 5627B, by the way. Try remembering the section if you're able to. Great. Otherwise, don't force yourself here. It's important if you remember section 56 charging section and section 56 to 10 gifts. These two you remember. This one up to you. So 5627B says there's a closely held company who has issued shares. Now these shares may be preference shares, they may be equity shares, doesn't matter. He has issued shares. Now against these shares, he is going to get money. He's going to get money from this person, Mr. Blue. He's going to get issue price, guys, against these shares. Now, there are some conditions. This person, Mr. Blue, should be a resident. This issue price has to be more than face value. More than face value, so what can you conclude? If more than face value, I can conclude that it has to be at premium, guys. And also, this issue price is more than the fair market value. It's more than fair market value. What does that mean? The shares are, let us say the worth of the shares, the market value of the shares is 100 rupees per share, but we're issuing the shares at 140 rupees per share. So the issue price is more than face value, which means it is at a premium, and it is also more than FMV of the shares. So how many conditions do you have here? Condition number 1, closely held company. Condition number 2, it has issued shares, equity or preference. Condition number 3, the shareholder is a resident. Condition number 4, the issue price is more than face value. Condition number 5, issue price is more than FMV. If all these conditions are fulfilled, we will see how much benefit has this closely held company enjoyed. Don't you think this company has enjoyed a benefit, guys? Because they're getting money against these shares even more than FMV. So we will see the benefit that they have enjoyed, that is issue price minus FMV. This difference is going to be taxable for this closely held company. Here we don't bother about the 50,000 number. See, if you look at 56 to 10, we talk about the 50,000 number everywhere. In each of the points, we have the 50,000 number, right? But not in 56 to 70. Irrespective of the 50,000 number, we have only 5 conditions. Condition number 1, it is a closely held company. Condition number 2, the shares may be preference or equity. Condition number 3, the shareholder has to be a resident. Condition number 4, the shares are issued above face value, which means the shares are issued at a premium. Condition number 5, the shares are issued above fair market value. So in this case, the excess which this company has enjoyed, the issue price minus FMV, the excess which this company has enjoyed, that excess is going to be taxable. Taxable for whom? Who has enjoyed the excess? The closely held company, right? It is taxable for this closely held company. Are you understanding? Yes, but listen, let us talk a little about this from the practical point of view. What do you think? Who's going to be affected by this section the most? Think a little practically. Don't you think our startups are going to get really affected by this? Are you able to connect? See, listen. A startup is initially going to be in the form of a private company. Private companies will be closely held company. They will try to raise funds. With a lot of difficulty, they will find an investor. They will pitch to the investor. The investor likes the pitch. They'll give a stake to the investor, stake shares. Against the stake, they'll ask for investment from the investor. The investment may be at premium. The investment will, in most of the cases, be above FMB because they will get a separate valuation done, and that valuation will keep in mind the future prospects of the company and not just the current market value of the company. So the money that they're going to raise from this investor against this stake will always be more than FMB in startups generally. The general discussion I'm having with you. So the point that the startups started raising was, company, a government, listen. On one hand, you're saying Startup India movement and all of those, all of those slogans that you're coming up with. But on the other hand, with a lot of difficulty, first of all, I'm arranging an investment. And out of that investment, even you want to share, even you want me to pay tax. Unfair. They started calling it the angel tax. Because angel investment, they use the word angel investment, right? Whenever venture capitalists and whenever investors give money against stake, they call it as angel investment. So they started calling this as the angel tax. So that is why the government came up with a notification saying that some startups who fulfill some conditions, like for the first 10 years, if a startup is getting any such extra money, we will not ask them to pay tax. But of course, there are many conditions that have to be fulfilled, like the turnover of that startup should not be more than 100 crores. that startup should be recognized. It should be recognized by DIPP. The capital of the startup should not be more than 25 crores. So there are some conditions, all right. So if those conditions are fulfilled, then this section will not apply to startups. But that's only for your information from the practical point of view. Exam perspective, this is all what you need to know about 56 to 7B. Okay, so under 56 to 7B, you will look at the issue price minus FMV. You will find this difference between issue price and FMV. This difference will be taxed for the closely held company, but remember the conditions. Condition number 1, it should be a closely held company. Condition number 2, they must have issued shares to a resident. It should be above face value, which means the issue should be at a premium, and it should also be above FMV. If all these conditions are fulfilled, then whatever is the difference between issue price and FMV, the difference will be taxed for the closely held company. Alright, so with this, we are done learning all the provisions under IFOS. We just have to start working out questions one after the other now. Alright, so as much as possible, we've also done this discussion from the practical point of view. Even dividend part, we've tried discussing as much as possible from the practical perspective, because you need that practical knowledge to help you with your articleship and all later. But I'm hoping till here you've understood it all. That's it with the provisions. I'm hoping you're noticing and realizing that it's actually a very, very simple chapter when compared to all the heads that you've learned until now. The only tricky thing, see, I will not deny, the only tricky thing over here is dividend. Rest of it is easy, guys. Rest of it is plain easy. Right? So, with this, I think we'll close our discussion on the concepts. So, our first two questions will be entirely focused on gifts, okay? We'll have to identify whether it's an exempt gift, whether it's a taxable gift, whether aggregate, separate, all of that. All right. So, let's begin with our first question. The question says, Miss Reema, who receives a salary of 20,000 per month, received the following gifts. They've given us information about 14 gifts. They're asking us to find her total income. Okay, so let's begin. We'll start computing her total income, because total income we're computing in not just IFOS. IFOS will only be a working note, right? So write down your heading. Give the heading computation of total income. Okay, then make a 3-columnar table, please. You need a particulars column, a working note column, and a column for amount. All right. Now, first of all, the question says she's receiving a salary. So, salary will go to which head? Of course, you know this. Salary will go to the head. Basic salary, guys, it will go to the head salaries. So, under particulars, write down salary. Give reference to working note number 1. All right. Leave some gap of probably some 4 to 5 lines. That should be enough. Open your first working note. Give the heading salary. So under this, we have basic salary. Let's do the calculation. 20,000 per month. So show your math. 20,000 into 12. That's going to be 2,40,000. So this is his basic salary. Okay. Then he's receiving gifts, guys. Very obvious. Looking at the question itself, there are a list of gifts that she's receiving. So gifts we know go to which head? IFOS. So come back to your main answer. IFOS, write down working note number 2. Okay. Now under working note, after working note number 1, leave 4 lines and then open working note number 2. Give the heading IFOS. All right. Now see, she has multiple gifts over here. Cash gifts, movable, then there is immovable, the different kinds of gifts. So therefore, within IFOS itself, you'll have various parts, guys. You'll have one part for each kind of gifts, right? So under this, write on point A, give the subheading cash gifts. Under this, leave some gap, probably leave some 10 lines gap under this. All right. Then write down point B. Point B, call it as movable gifts, no consideration. All right. Under this, leave some 3 lines gap. Then point C, movable gifts, inadequate consideration. All right. Again, leave 3 lines under this. Then you will have category D, Immovable gifts, no consideration. Okay, leave 3 lines under this again. And finally, immovable gifts, inadequate consideration. Guys, please, by the way, please do this. Go to your rules page. You've made a page for rules, right? I've already made you write, I think, a set of 8 to 9 rules, right? So under that, write on one of the rules, immovable gifts, inadequate consideration, 6 steps. So as soon as you see immovable gifts, inadequate consideration, we have to apply our 6 steps. You've written a list of rules already over there. You've written about deemed resident rule. Then you've written a rule about partial integration method. Remember, you've written a rule about residential status. Now, and then you also wrote a rule in the last session in capital gains about splitting your GTI. So write one more rule over there, please. Immovable gifts, inadequate consideration, 6 steps. So as soon as you come to immovable gifts, inadequate consideration, your brain is supposed to tell you about the 6 steps. And do you remember a common point about these 4? What was a common point that we learned about these 4? There was one common point. Yeah, correct. It has to be a capital asset. Only if it's a capital asset for the recipient, only then you even think about it under gifts, right? So your table is ready. Now come on, let's begin, guys. Gift of 5 lakhs from a friend. It's from a friend. So is it exempt or taxable? It's going to be taxable. See, don't bother about the 50,000 number right now because see, it is cash. Whether it is taxable or not, whether the number is taxable or not, that would depend upon the aggregate cash gift. So right now, don't bother about the amount, okay? The only thing that matters right now is it's gift from a friend, and gift from a friend is not an exempt gift. So write down under cash gift, point 1, gift from friend, amount 5 lakhs. Okay, then gift of jewels, FMV of which is 3 lakhs from her fiance. So tell me, first of all, gift of jewels. Which bucket should I even think about? Movable gifts, guys. It is gift of jewels, movable gifts for no consideration. It will come under this bucket. Is it capital asset? Are jewels considered as capital asset? Yes. Remember, we've learned under capital gains, they are excluded from personal effects. They are capital asset. Now, she's receiving it from her fiance. Is fiance considered as relative? No. Spouse is relative, but fiance is not a relative. All right. So, therefore, non-relative, jewels, movable asset, no consideration, taxable. What number will you tax? The FMV number, FMV, which is 3 lakhs. So, under movable gifts, no consideration, write down jewels from fiance, amount 3 lakhs. All right. You understood? It is gift from a non-relative and also it is capital asset, movable asset, no consideration, taxable. It is not necessary that the gift is received on the occasion of marriage just because it is from her fiance. You cannot conclude that it is relating to marriage. All right. The third exception, the third situation now. Gift of 51,000 each received from her 4 friends on the occasion of her marriage. Guys, she's receiving cash from 4 friends on the occasion of marriage. It is on the occasion of marriage. So does it matter how much is a gift? Does it matter from whom she's receiving the gift? No. Any gift on the occasion of marriage, fully exempt, right? So under which bucket but? Rupees 51,000 gift. Which bucket? Cash gifts, right? So our very first bucket, come to cash gifts. Under this, write down point 2. We have rupees 51,000 from 4 friends, in brackets write down marriage. So write down exempt. It's going to be fully exempt because it is on the occasion of marriage. Done till here. Let's proceed then. What else? Gift of 1 lakh from a mother sister. Tell me, is mother sister relative? Try to recall your diagram. This was your diagram for relative. If I am the assessee, my mother is relative, mother's brothers and sister also relative. So exempt or taxable? Gift from relative, guys, exempt. So point number 3, write down mother's sister. In brackets, write down relative. So therefore, this is going to be exempt. Okay. Then father's brother, relative. Do you agree? Same logic, father's brother relative, even this is going to be exempt. So point 4, father's brother. In brackets, write down relative. Under the amount column, write down exempt. Then what else? Gift from her husband's friend. What about this? Husband's friend is going to be taxable. Should you bother about the amount right now? No. Aggregate, right? So write down point number 5. Husband's friend. What is the amount? 50,000. And then gift of 21,000 from a mother's friend. Mother's friend exempt? No. Mother's friend taxable, not a relative. Mother's friend amount 21,000. Then gift of 26,000 from her brother's father-in-law. See, brother is considered as relative. My father-in-law is considered as relative, but brother's father-in-law, relative guys. No, brother's father-in-law not a relative. So point number 7, write down brother's father-in-law. In brackets, write down not relative. So what is the amount? From a brother's father-in-law, she got 26,000. Then gift of 1,21,000 from a husband's brother. Is husband's brother relative? Yes. Spouse. Spouse is brother and sister, relative, right? So point number 8, write down husband's brother. In brackets, write down relative. So this is going to be fully exempt. All right. Then gift of 26,000 from her employer. Where will gift from employer go? This will go under the head salaries. Now listen, salaries, gift. Does any number come to your mind? 5,000 number. Very good, guys. Very, very good. 5,000 number. But 5,000 number, will it apply to cash gift also in salaries? No. Remember, 5,000 number will apply only to gift in kind in salaries. So in salaries, we learned if the gift is in cash, it is fully taxable. But if the gift is in kind, you will see the value of the gift. If it is less than 5,000, it is not taxable. If it is equal to 5,000 also, it is not taxable. If it is more than 5,000, only then it is taxable. Remember that discussion? So that 5,000 number should come to your mind whenever you think about a gift under salaries. But under salaries also, gift in, if it is a gift in kind, you have a 5,000 number. But only for gift in kind, not for gifts in cash. So this is a gift in cash. So you don't even have to think about the 5,000 number. It's going to be fully taxable, but under the head salaries. So come to your salary working note and write down gift from employer. We will not write about the 5,000 number. We would have written had it been a gift in kind. But because this is a gift in cash, I'll fully tax this 26,000. All right. So even this is done. Then what about this, guys? Scholarship of 1,20,000 from a charitable institution registered under section 12AA. We learned this, remember, under exempt gifts. Any gift I receive from a charitable institution is fully exempt. From an approved charitable institution is fully exempt. So come to your cash gifts, write down point 9. Scholarship from charitable institution exempt. Then look at the next one. She purchased an immovable property from B, who is not her relative, for a sum of 24,50,000. STV is 26 lakhs. Which concept? Which category? What comes to your mind? She purchased an immovable property from B, who is not her relative, for a sum of 24,50,000. STV is 26 lakhs. Tell me which concept comes to your mind. Amazing, guys. Amazing. 6 steps. Very, very good. Let us look at all the wrong answers now. Listen. See. Point by point. Somebody had said 49.4. Okay, they deleted the message. So whoever said 49.4, we think about capital gains only from the point of view of capital gains. 49.4 is only in capital gains. And capital gains is only for the seller, right? Who is our assessee over here? Our assessee over here is Miss Reema. She purchased. From buyer's point of view, which head of income do you apply? IFOS. I told you that. From the seller's point of view, you apply capital gains. So had you been doing the calculation for B, There you could have applied capital gains. But here we are doing the calculation for Miss Reema. She is a buyer. So buyer's perspective, you apply IFOS. Later, if she is selling it, then you will apply capital gains. Then maybe you can apply 49.4. Right now, she is not selling it. Right now, she's just purchasing it. For the purchaser, for the buyer, you only and only apply the IFOS head. Crystal clear? This mistake shall not happen again. We cannot go wrong in identifying the head of income itself. That's like a blunder. Right, guys? So anyways, coming back to this is immovable property inadequate consideration, guys. Something worth 26 lakhs we acquired by paying just 24 lakh 50,000. This is immovable gift for inadequate consideration. You remember the 6 steps, right? Tell me, what was your first step? Step 1, STV number. See, had they given us FMV number and all, we would have done all that thinking. They did not give us. They've just given us STV 26 lakhs. So we'll take this number as it is. So STV 26 lakhs. Then what is step 2? Try to tell me without seeing, try to tell me out of memory. What's your step 2 number? The actual consideration. Very good. Actual consideration doesn't look like you've been sitting since morning. Actual consideration, how much did your assessee pay? 24 lakhs 50,000. Then what is step 3? The difference. What is the benefit that our assessee has enjoyed? The benefit that he has enjoyed is 1,50,000, right, guys? Something worth 26 lakhs he got by paying just 24,50,000. That's a benefit that he has enjoyed. Now, is this number taxable or not? Depends upon step 4, 5, 6. What is step 4? The standard. What is a standard? Always 50,000, right? Then step 5. Step 5, 10% of what? 10% of consideration, guys. So 10% of actual consideration, that is 24 lakh 50,000 into 10%, that's going to be 2 lakh 45,000. Then comes step 6. Step 6 will be step 4 or step 5, whichever is higher. So 50,000 or 2 lakh 45,000, whichever is higher, clearly 2 lakh 45,000 is higher. Now tell me, will anything at all be taxable here? Perfect. Very good. Perfect answers. Give me the reason why. As step 3, write down. As step 3 does not exceed step 6. Step 3 is not taxable. So nothing is going to be taxable. You know very well, only if this number is more than the step 6 number, only then step 3 is taxable. If at all something can be taxed, only step 3 can be taxed. And you can tax step 3 only if step 3 is more than step 6. Here step 3 is less than step 6. Therefore, nothing at all is taxable. Alright guys, so this was our discussion regarding this adjustment, the 12th adjustment. Shall we go ahead? Shall we go a step forward to the next adjustment? Look at the 13th step. She purchased a bullion for 4,40,000 whose FMV is 4,85,000. Which concept is this? Which concept is this? Movable gifts for inadequate consideration, guys. But first of all, is bullion considered as capital asset? See, what is a bullion? A bar of gold is bullion, right? It is considered as capital asset. So therefore, I can think about it under my gift calculation. It is movable asset for inadequate consideration. Something worth 4,85,000 my assessee acquired by paying just 4,40,000. So come to movable asset, movable gift, inadequate consideration. Write down under this bullion. Show the difference. What is the FMV? FMV is 4,85,000. Assessee has paid how much? 4,40,000. So what is the benefit our assessee has enjoyed? 45,000. And finally, guys, she got a gift of immovable property from a friend whose STV is 5 lakhs. Gift of immovable property from a friend. So this is going to be immovable gift, no consideration. So under this, write down from friend. So what is the STV of this property? 5 lakhs. Okay, so that's it with the question. Let's close our working notes one by one. Come to the first working note, add up 2,66,000. What would you call it? Gross salary, I'm hoping some adjustment comes to your mind after this. Very good, very good. We subtract deductions under section 16. Remember, we have standard deduction, guys. Standard deduction, how much do you enjoy in salaries head? 50,000. So the balance 2,16,000. This becomes your taxable salary. Right? So go back to your main answer. Taxable salary 2,16,000. Done. Now listen, come to the IFOS calculations, okay? Add up the total cash gifts. Totally, how much do you get now? 5 lakh plus 50,000 plus 21,000 plus 26,000. It is 5,97,000. Now tell me, for cash gift, do I look at each gift separately, the numbers whether taxable or not? No. Cash gift, you look at the aggregate. Now this aggregate, if you see, it is more than 50,000. So therefore, what will you conclude? Excess taxable or fully taxable? You know this. Aggregate is more than 50,000, therefore fully taxable. That's all, guys. So write down rupees 5,97,000 fully taxable. Okay, then listen. Movable gifts 3 lakhs. So even here I'm supposed to find the aggregate. What is the aggregate? 3 lakhs. This aggregate is more than 50,000. Therefore taxable, not taxable. Taxable. And fully taxable or excess taxable? Fully taxable. So write down therefore rupees 3 lakhs fully taxable. Okay. So here we have 5,97,000. Here we have 3 lakhs. Then movable gifts 45,000. I will not look at it aggregate. I will look at I will not look at it separately. I will look at the aggregate. The aggregate is 45,000, which is within 50,000. Therefore, exempt. Did you notice? I did not make a decision at this step. Where did I make a decision? Only after finding the aggregate. These small things make a difference. Are you understanding? Yes. So under this, write down as aggregate does not exceed 50,000, exempt. So this one is exempt. Now, immovable gifts, do I have to find the total? No. I will look at each step separately. So this 5 lakhs, I don't have to find the total. Here itself, I will say this 5 lakhs is more than 50,000. Therefore, rupees 5 lakh taxable. You are understanding? I will not look at the aggregate here. Each transaction separately we will see for immovable. So 5 lakhs fully taxable. Here 5 lakhs is taxable. And for immovable gifts inadequate consideration, we have already concluded nothing is taxable. So write down towards the end summary. So what's your total taxable gift now? You have 5,97,000 taxable under cash gifts. Then you have 3 lakhs taxable under movable gifts. And you have another 5 lakhs taxable under immovable gifts. So your total taxable number is going to be 13 lakhs 97,000. Do you get this? Five lakh 97,000 plus another 5 lakhs plus 3 lakhs. This is going to be 13 lakh 97,000. So this is your total IFOS. Come back to your main answer. IFOS 13 lakh 97,000. No chapter 6A in this question, guys. So straight away, what's the total income of our SSE? 16 lakhs 13,000. Okay. See, I'm not saying that the same question as it is will come in your examination. Chances are pretty less. Then why did we do this? because we've covered a lot of gift adjustments in this question. Any of these adjustments can form a part of your total income questions. Any of these adjustments can form a part of your MCQs. So this question was mostly to help us apply all our conceptual knowledge under gifts. All right, one or two similar questions, if you're able to do, then any adjustment under gift you will be able to handle. That's the whole objective. Simple, guys. Yes, are you noticing? It's just a plain application of what you have learned. Are you done with this? Just one last question, let's work out. One more similar question, covering some more adjustments under gifts. Okay, the next question, which is question number 3. Now, question number 3, yes, I'll show you one moment. The Boolean part, is it? This part? Tell me when you're done, please. All right, listen. Let's go to the third question now. You will not have the second question in your handout. You'll straight away have the third question, I think. This one. This Mr. X, aged 42 years. This is the one that we're going to work out next. In this question, there are totally 10 subdivisions. The first 9 will be to help us, apply the gift provision a little better. The major learning over here will be in the last adjustment, where we're going to be learning a special concept relating to clubbing. Our next chapter is supposed to be clubbing. So something to do with clubbing you will be learning over here. All right. See, in your handout, you may be having question number 2, but that question number 2 will be the same as this, I'm supposing. Right? The question number may be a little wrong, may be different, but it will be this question. I just want you to spot this question, whatever be the question number. All right. So let's begin. So 2 or 3, whatever it is in your handout. Listen. Mr. X gives the following information for the relevant year. They're asking us to find the net income. What does net income indicate? The total income. All right. So give your heading computation of net income. Make a 3-column table, please. You will have a broad particulars column, 1 column for working note, and 1 column for amount. Now, under particulars, he gets a gift. So gift obviously will go to IFOS head. Give reference to working note number 1. Leave probably 3 lines gap. Then open your first working note. Give the heading IFOS. Okay, let's make our table first. Write down cash gifts. Under this, leave some 7 lines gap. Then after this, write down movable gifts. No consideration. Leave some 3 lines gap. Then movable gifts. Inadequate consideration. Again, leave a gap of probably 5 lines or 6 lines. Then write down immovable gifts. No consideration. Leave 3 lines. And finally, immovable gifts. Inadequate consideration. Okay, are you ready? I'm hoping the table is ready. Shall we begin? Come on, let us look at the adjustments. First of all, he gets a gift of house A from his friend B. Which category? House. Immovable. Is he paying anything? Nothing at all. So therefore, immovable asset, immovable asset, no consideration, guys. So he's getting house A. Under this, write down house A. Under removable gifts, no consideration, house A. It's from his friend. Friend is not relative, not exempt. What is the SDV? SDV is 6 lakhs. Should I bother about whether it is more than 50,000 or not at this step? Yes. Yes, guys, immovable asset, right? Immovable asset, you look at each transaction separately. So separately, if I'll have to look at each transaction separately, it is more than 50,000. So therefore, I will consider it. This is 6 lakhs. All right. Then, done with this? Next adjustment. He gets a gift of house B from C, who is father-in-law of his elder brother. Tell me, father-in-law of elder brother considered as relative? No. So SDV is 40,000. Current market value is 65,000. They've given us SDV and market value. FMV is more than SDV. So you will stick to SDV. Very good. SDV is 40,000. Is it going to be taxable? You will look at each transaction separately. It is immovable, guys. It is immovable. House B immovable. SDV is only 40, which is within 50. Hence, anything taxable? No. See, had it been cash gift, had it been movable gifts, I wouldn't even have thought about the 50,000 number right now. Right? Because if it is movable gifts or cash gifts, only the aggregate number we are bothered about. But this is immovable. So immovable, we'll have to think at each step itself. So it is house B, it's an immovable asset. It is from the father-in-law of his elder brother, who is not a relative. They've given us SDV and FMV. FMV is more than SDV, so we stick to SDV. But SDV is only 40, which is within 50. Hence, anything taxable? Nothing taxable. Right? So write down under immovable gifts, no consideration, house B, in brackets write down SDV does not exceed rupees 50,000. So write down not taxable. Only if it is more than 50,000, we will tax it. Right? That was a second point over here. Now come to the third point. X purchases a second-hand car for 87,000 from D. Market value is, however, 3 lakhs. Which category is this? Movable asset. Movable asset for no consideration or inadequate consideration? He's paying 87,000, guys. It is worth 3 lakhs. So movable asset, inadequate consideration. Write down car. But however, does any concept come to your mind? It just says car. It's movable asset. Personal purposes. Therefore, what does it become? Personal effect. Therefore, it is not a capital asset. So, will you even think about taxing it? No. We know very well movable and immovable assets will be taxed only if they are capital assets. So, movable gifts inadequate consideration under this write on car. In brackets, write on personal effect, comma, not a capital asset. So, in the amounts column, not taxable. Done, done, done. Come to the fourth subdivision then. X purchases a work of art for rupees 5 lakhs from, no wait, 1 minute. Yeah. So X purchases a work of art for 5 lakhs from E. FMV is 5 lakh 30. Work of art. Which category? Cash gift, movable, immovable. Movable, guys. Movable for no consideration or inadequate consideration? Inadequate, no. He's paying 5 lakhs. It is worth 5 lakh 30. At this stage, should I bother about the fact that the difference is only 30,000 less than 50,000? No, no, right? You do that only for immovable. For movable, only the aggregate you will compare with 50. So therefore, movable gifts, inadequate consideration, write down work of art. By the way, isn't work of art also movable and personal purpose? No, it is excluded from personal effect. It is considered as capital asset. You know it, right? We've discussed it in the capital gains head also. So what's the difference? What's the benefit he's enjoyed? Something worth 5 lakh 30 he obtained by paying only 5 lakhs. So the difference is 30,000. All right. Done with this also? Then next adjustment. He purchases jewels for 7 lakhs. FMV is 7 lakh 25. Again, this is movable asset for inadequate consideration. Jewels, show the calculation. It is worth 7 lakh 25,000, guys, but he is paying only 7 lakhs. So what's the difference? 25,000. All right. Then after this, the next adjustment. X purchases a painting for 4 lakhs from G, who is brother of Mrs. X. Brother of spouse. Spouse is brother considered as relative. So write down painting. It is movable asset inadequate consideration, guys. So under that, write down painting. In brackets, write down from relative exempt. He got it for inadequate consideration. It is worth 7 lakh. He paid only 4 lakh, but because it is from relative, exempt. Then after that, the next adjustment, he purchases a commercial property for 75 lakhs from H. STV is 90 lakhs. Which concept? A property he purchased for 75 lakhs, but SDV is 90 lakhs. This is again immovable asset, inadequate consideration. Immediately what comes to your mind? The 6 steps, right? So come to immovable assets, inadequate consideration. Under this, write down. By the way, is it from a relative and all? Is it an exempt gift? No, it just says from some H. So therefore not an exempt gift. So under this, what is your first step? Step 1, STV. STV is 90 lakhs, guys. Then what is step 2? Actual consideration. What is the actual consideration? How much did we pay for this property? 75 lakhs. So what is the difference? Step 3, difference. What is the benefit that he has enjoyed? He has enjoyed a benefit of 15 lakhs. Now, is this 15 lakhs taxable or not? Depends upon step 4, 5, 6. So step 4, what is the standard always? You know it. The standard is 50,000. Step 5, 10% of consideration. That is 75 lakhs into 10%. Right? And that's going to be 7 lakh 50,000. Then step 6. What is step 6? Step 6 would be step 4 or step 5, whichever is higher, and that is 7 lakh 50. Now tell me, taxable, not taxable? Taxable, right? 15 lakhs is more than 7 lakh 50. So whether step 3 is taxable or not, if at all something is taxable, only step 3 can be taxed. Now whether that number is taxable or not depends upon step 6. As step 3 is more than step 6, step 3 will be taxable. So write down as step 3 exceeds step 6, rupees 15 lakhs is taxable. So we tax it fully or do we tax the excess? By now you must have understood this. In the whole of gift, we tax it fully. We don't tax just the excess, we tax it fully. Right? So that is it about this adjustment. Are you done writing? Yes, can I proceed? Great. Look at the next adjustment now. He gets a gift of 100 preference shares of A Limited from J. On that date, the stock exchanges are closed. Lowest quotation of immediately preceding working day in National Stock Exchange is 45. What about this? He gets a gift of 100 preference shares. The fair market value is 45 rupees per share. It's a movable gift, guys. No consideration or inadequate consideration? No consideration. 100 preference shares. So come to movable gifts, no consideration. Write down 100 preference shares. Show the calculation in brackets, please. 100 shares, and what's the market value per share? 45. That's going to be 4,500. Should I bother about the fact that it is less than 50,000 right now? No, only the aggregate, right? That's about this point. Shall we go to the next point, the 9th point? Look at the 9th one. He gets a gift check of 1 lakh from his friend L on his birthday. Point by point. Gift check. Cash gift. Friend. Is friend exempt? No. Is birthday exempt occasion? No. So 1 lakh straight away under cash gift. So come to cash gift. Under this, write down from friend 1 lakh. Now comes the most important adjustment in this question. Listen to me. See, listen to the concept first. If your assessee has a minor child, and if this minor child has earned an income, sometimes this income is clubbed. Clubbed means what? Clubbed means, see, sometimes minor child pays his own taxes, but sometimes some of his incomes are clubbed. Which income is to be clubbed? Which income he himself has to pay tax? We learn all that in our clubbing chapter. Right now, what do you need to know? If your minor child has earned an income, you will first do the full computation in the minor child's hand. The computed number, the taxable number, you will take from the minor child's hands and you will club it with the assessee's income. After clubbing it with the assessee's income, you will give the assessee 1,500 exemption per child, no limit on the number of children. This is the concept. So I'll repeat again. If the minor child has earned an income, some incomes are clubbed, some incomes minor child himself pays tax. If the income has to be clubbed, you will first do the computation in the minor child's hands itself. What is taxable, what is exempt? Think from minor child's point of view, do the computation from the minor child's perspective itself. That computed number you're supposed to club with the assessee's income. After clubbing with the assessee's income, you give 1,500 exemption to the assessee per minor child. Once you club it with the assessee's income, now you will treat it as if it is assessee's own income. Understood, everybody? Yes, fine. But listen, when are you supposed to do clubbing? Understand that also. For the assessee, when are you supposed to club others' income into the assessee's hands? For the assessee, you're first supposed to do his own computation. Finish his own computation first, only then club. Alright, so first let us finish his own computation. Then we will think about clubbing the income. So first let us close his own computation. Come to each of the steps one by one. What is his total cash gift? Aggregate 1 lakh. Guys, aggregate is more than 50,000. So therefore I can say that 1 lakh is taxable, guys. Aggregate cash gift more than 50,000. Therefore 1 lakh is taxable. Movable gifts, no consideration. I'll again find the aggregate. The aggregate is only 4,500. It is within 50,000. Therefore, not taxable. Right. Movable gifts, inadequate consideration. Total is 55,000. Total 55,000 more than 50,000. So therefore, because it exceeds 50,000, 55,000 is going to be fully taxable. So 55,000 taxable. So cash gift 1 lakh is taxable. Movable gift inadequate consideration 55,000 is taxable. Immovable gifts, if you see each step separately, we will see 6 lakhs is more than 50,000. Therefore 6 lakhs is definitely going to be taxable, right? So here this 6 lakh is taxable. And immovable gifts inadequate consideration, we've already concluded 15 lakhs is taxable. So therefore, if we have to give a summary, what's a total taxable gift now for the assessee? I'm talking about his own income, his own taxable gift. Cash gift, you have 1 lakh. Then you have 55,000 of movable gifts inadequate consideration. Then you have 6 lakhs of immovable gifts no consideration, remember? And then finally you have another 15 lakhs. So what's the total? One lakh plus 55,000 plus 6 lakhs plus 15 lakhs, you will get 22 lakhs 55,000. Do you get this number, everybody? Yes. So what have we done as of now? His cash gifts aggregate was more than 50,000 taxable. Movable gifts within 50,000 not taxable. But movable gifts inadequate consideration aggregate more than 50,000 taxable. Immovable gift, we saw each transaction separately. So his own computation we have completed. Now we will think about clubbing. Now listen. Minor child of X gets a gift of 55,000 from elder brother of X's grandfather. Minor child is getting a gift from his father's grandfather's elder brother. Tell me, first you will do the thinking in the minor child's hands. Think from the minor child's point of view. Is it an exempt gift or is it a taxable gift for him? See, parents, brothers and sisters, relative. Parents, grandparents, great-grandparents, and so on, relative. But elder brother of father's grandfather, which means great-grandfather's brother, relative, guys? Of course not. Great-grandfather, relative. Father's brother, relative. But great-grandfather's brother, not a relative. So therefore, and also it is more than 50,000. So therefore, for the minor child, it is taxable, guys. Are you noticing I'm thinking from minor child's point of view? So minor child's point of view, it is taxable. So what's a computed number? What's a taxable number? 55,000 taxable number. This computed number, I will club with Mr. X's income. So Mr. X's income is 22,55,000 plus minor child's clubbed income, 55,000. But you will also enjoy Section 1037 exemption. What is the exemption I told you? Per child, 1,500 exemption you will get. So what's your net number now? 23,08,500. This will become the total IFOS of our assessee, 23,08,500. We first did assessee's own computation. Then we realized minor child has earned an income. So there will be clubbing. So we thought from the minor child's point of view. From his perspective, if you see 55,000 is taxable. The taxable number, the computed number, I will club with my assessee's income. So I will club that 55,000 with my assessee's income. After clubbing, I will give him 1,500 exemption. I have a question for you at this stage. What if this 55,000 was 51,000? Would you still club? Would you still club if this 55,000 was 51,000? Think. I know last part of the session I'm asking you a question. I know you might be cursing me as well, but one last question, please. If it was 51,000, would you still club? The reason is because 51,000 minus 1,500 is 49,500, which is less than 50,000. That's why I'm asking you the question. Yes, you would still club. Why would you still club? Because first you do the computation in the hands of the minor child. For the minor child, if you see 51,000, it is more than 50,000. For the minor child, it is taxable. So computed number, you will club with Mr. X's hands. Once you club it, it becomes his own income. After clubbing, you will give 1,500 exemption. After giving exemption, more than 50, less than 50 doesn't matter. Because where will you think about 50, less than 50, more than 50 and all? Who has earned the income? Minor child. First computation you do in the hands of the minor child. In the hands of minor child, you have already concluded it is taxable. So therefore, it will definitely be taxed. It will definitely be clubbed. After clubbing only, you give the 1,500 exemption. So after clubbing, you don't think about taxable, not taxable, exempt, not exempt. You don't think about all that because all that thinking you've already done in the hands of minor child. That's why I'm saying again and again, first compute in minor child's hands. Once you conclude it's taxable for him, that computed number, the taxable number, you club. Once you club, I don't think about taxable, not taxable, exempt, not exempt and all. Straight away, I'll give 1,500 exemption. So come back to your main answer, guys. 23,08,500. No other income. So this itself becomes a net income of our assessee. All right. Are we clear with this? Did you understand this? Yes, guys. Comfortable? Right? It's a very simple chapter. It's not as bad as the chapters that we've done all with this while. Right? So we'll close over here. All right. I think you should be appreciated in capital letters for being this cooperative. All right. And also being this participative even towards the end of the day, which was very surprising and it was really nice to see. So well done, guys. Very, very well done. Take a well-deserved break for some time now and then get back to whatever plans you have to study this evening. All right. So you've done amazingly well. This chapter should become your strong chapter. All right. It is one of the easiest chapters. It should become your strength. All right. So with this, we'll close over here, and I'll send you the recording for the rest of the questions. Simple only. All right. Nothing much. I'll see you next for clubbing. Thank you guys. Bye bye.